Well, let's kick this around with our guest, Kathryn Rooney Vera, Baltic Capital Markets Chief Investment Strategist.
I'm looking at some of the market action here. Cassava Sciences was up 50%. That was on Reddit. And now it's just about up 31%. But that meme stock and the day traders, like, clearly in the market in some capacity. Kathryn, it's great to see you. Same question for you. What signals an unviable dip?
Well, of course, a dip by definition is something that's going to bounce back. So if we know it's a dip ahead of time, everyone's going to be buying it. But a major correction, I think, would have to be precipitated, Alex, by the market realizing or knowing for sure that the Fed is not going to be there to support it. So a loss of credibility by the Federal Reserve, or a change in, not just a change in tune, Alex, but a complete 180-degree shift in how the Fed engages in monetary policy, I think would be what would startle the markets and cause a major downside reaction. That is, of course, that the Fed is, not just suddenly cuts tapering altogether and hike rates, or does something to that vein. I think it would cause the market to really lose faith in this structural upside move that we've seen for the past, decade.
Yeah, it's been about a decade. Kathryn, have you been surprised how well investors, particularly equity investors, have taken in their stride what the Fed has done? We've had an accelerated taper. The market shrugged its shoulders. Yeah, we're still good to go. We've got 3 rate hikes priced in for next year. Yeah, you know what? We're good to go. What Fed policy would actually change the narrative that the market is comfortable with? What would it take to get us over that hump? Maybe the balance sheet roll-off, is that a factor we should think about? How should we think about the Fed and the way that the market is reacting to it?
The market just sees that the Fed is infallible, right? It's just stunning that you can see this amount of curve flattening and this amount of little reaction by the Treasury market to a Fed that's really changed its tune, Guy, right? I mean, instead of 2, we have 3 hikes. We have a doubling of the taper. We have certainly more hawkish bent. The central bank saying that inflation is enemy number 1 to the economic recovery. So, and the market really is unscathed. That tells me that the market is already discounting both an economic deceleration, which is inevitable because this year we will have grown above 5.5% for the U.S. economy, but also that the Fed is able to tackle inflation so that, yes, there is inflation. We know it, we realize it, but the Fed has got it. So what could really deconstruct that, pillar of the market mentality would have to be that the Fed is hiking rates, but inflation still doesn't come down. And that we're not going to have until the second half of next year. So, Guy, my view and what I'm telling our clients is risk is still on, stay long, overweight equities, continue to buy any scare on a new variant. It's clearly a buying opportunity. We've seen it with Delta. We've lived it with Omicron. So continue risk on positions, but hedge those, buy those sectors. And we've said this at Baltic for the past year. Inflation is the real risk. Buy inflation and rate sensitive and asset classes that can protect that other portion of your more risky portfolio.
Yep. In the meantime, buy the dip, ... until something changes in that respect. Hey, Kathryn, you outlined what we need to see a serious correction. Let's play the what if game. What goes on sale if we see something that dramatic?
What goes on sale? Yeah, I mean, if we get a 20% correction, and it depends on, of course, what the motor of that correction is. But as Vincent said, I think it's a good point. Real wages are what you need to be looking at, especially if we're talking about inflation and how, persistent, or as the Fed, I think, jokingly must have been joking when they said persistently temporary. But really the question, I think, is with the wage price spiral. So as he said, and that's right, if you get real wages that are continually and persistently increasing, as we have seen, real wages are up, and they're up big. If that's not counterweighted by by productivity gains, which Jay Powell has consistently said has been the case, but if that ends up fading, or we get a drop in productivity, then we get some serious inflation pressures from the wage perspective, the wage price spiral, which I think is, of course, very pernicious. So we have demand pull inflation, we have bottlenecks. If Omicron ends up exacerbating the issues that we've seen with the global supply chain, then inflation becomes even a bigger issue. So my biggest concern here remains the risk of policy error. Either the Fed has to jack up rates either in a bigger magnitude and quicker, or they take a more dovish stance and let this unfold because they're concerned about unemployment, they're concerned about economic growth. The Fed is going to be hiking in an environment of decelerating economic growth.
Right.
That's not a comfortable place to be hiking rates. So there's definitely risk, and I agree with your other guests with regard to risks going into the future. I do think, though, that the Fed is going to give inflation a pass for the next 6 months. So I'm more on the bullish camp for the next 6 months. I think risk stays on. I think the Fed is still backing the market. We've heard 2Q, 3Q. Jay Powell says he expects inflation to decelerate.
Yeah.
If we don't get that, then I do suspect we're going to be seeing more aggressive moves from the monetary policy front.
All right, and we're going to break down kind of what all this means for other asset classes elsewhere as well. Guys, thanks a lot. Vincent Signorella, always good to see you. Kathryn Rooney Vera of Voltic Capital.